After a year of lockdowns, Americans are returning to the roads. And as traffic picks up, so are prices at the pump. Gas prices have increased 44% this driving season, hitting an average of $2.18 per gallon. That's up from an average of $3.14 per gallon a year ago. And while prices tend to rise every summer because of vacation travel, this year's price gains are even higher thanks to the post-COVID rebound. Investors Business Daily reporter Gillian Rich explains.
There's a lot going on both the demand and the supply side. Demand has been picking up a lot quicker than analysts were expecting as COVID vaccines roll out in the US and Europe.
Rich adds that while demand has skyrocketed, supply has been slow to catch up.
When you go from dead zero to 60 miles an hour, maybe a Tesla car can do that, but a shale producer can't.
There's a lot of logistics that need to be ramped up, from calling back crews. Lots of workers have moved on to other industries, to drilling, completing wells before we will see production really ramp up in the U.S.
The specter of past boom and bust cycles has also left U.S. oil producers hesitant to ramp up output. Back in 2008, West Texas Intermediate oil hit a peak of $147 a barrel. That price held between $70 and $115 from August 2009 through July 2014. Then the U.S. shale oil boom took off, triggering a global oil glut which cut prices by more than half in the 2 years after.
There's no longer this drill baby drill mentality in the U.S. shale oil fields. Now they're more mature companies, and both Wall Street and banks are expecting them to focus less on this massive growth in production and focus more on strengthening their balance sheet, returning cash to shareholders.
This fear of oversupply is why OPEC members are taking a more measured approach to increasing oil output. Rich says striking the right equilibrium between supply and oil prices is a delicate balancing act for OPEC officials.
On the one hand, they need oil prices high enough to balance their budgets. On the other hand, they don't want oil prices too high that will spur new drilling in the US and also hamper the global economic recovery from COVID-19.
OPEC left its 2021 forecast for global oil demand unchanged in its latest report. And so far, members have been unable to come to a decision to amend their output policy. The cartel estimates consumption will rise by 6 million barrels a day this year to average 96.5 million barrels a day. But OPEC has only restored about 40% of its production capacity since COVID shutdowns took hold in 2020. And a potential deal between Iran and Western powers could also shake up the global oil market.
When the Trump administration left the Iranian nuclear deal in 2018, that removed Iranian crude from the global market. And if the two sides can reach a deal, 1.5 million barrels of Iranian oil can re-enter global markets.
As OPEC mulls increasing oil supplies, production continues to move slowly here at home. The Baker Hughes rig count, which tallies the number of new wells being drilled in the U.S., hit 475 in June. That number is up from 400 in early February. But the industry had over 960 rigs at work during the same period in 2019. Some oil executives don't see U.S. production returning to pre-COVID levels of 13 million barrels per day for 3 to 4 years.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.